Welcome to the Deep Dive. We're here to really break down complex topics and get you informed. Quickly, today we're tackling something pretty important in financial reporting. Subsequent events. You might also hear them called post-balance sheet events. Think about it like this. A company finishes its year, maybe December 31st. But the financial statements, the report card, well, that doesn't come out for weeks, sometimes months. And, life happens in that gap, right? Significant things can occur that really change how you should view that company's financial health. It's not just a static picture. Before we dive deeper, though, just a quick reminder, this deep dive draws heavily from material provided by Farhat lectures. All the content, the examples, the explanations we're discussing today, they come from the comprehensive accounting resources over at farhatlectures.com. So whether you're an accounting student studying for a CPA exam or already a professional, definitely check out the website. They've got extra practice questions, video lectures, lots of support to help reinforce what we covered today. And a big thanks to Professor Farhat for making this valuable material available to us.
Okay, so let's get into it. This gap, this period between the balance sheet date, say December 31st, and when the statements actually get issued. What's really going on then? Is it just downtime?
Oh, definitely not downtime. It's actually a really busy period. Think about the practicalities in the real world. You've got your December 31st balance sheet date, but those reports might not see the light of day until maybe March 1st.
Right.
And there's a ton of reasons for that delay. You have to do physical inventory counts, reconcile all the different ledgers, prepare all those, crucial adjusting entries to make sure the numbers are right.
Yeah.
Then you're collecting information, verifying everything, and of course the auditors need their time. They have to finalize their own report and give their sign-off. It's during this specific time frame between the balance sheet date and the issue date that these significant things can happen. We call them subsequent events.
Okay, so subsequent events are these important transactions or, happenings that pop up after the year-end date, but before we actually see the final report. And I understand there are two main categories, right? Why split them up?
Yeah, that's really the crux of it. The classification is incredibly important because it tells you exactly what to do about the event, accounting-wise. I mean, do you need to go back and actually change the numbers for the year that just ended, or do you just need to tell people, hey, this new thing happened? That leads us straight into type 1 and type 2 subsequent events, and they have very different impacts on the financial statements.
But let's unpack type 1 first. This sounds like where it gets really interesting, especially if you're trying to figure out what really happened in the past year. These are events tied to conditions that already existed on the balance sheet date. Is that right? Like perfecting the past picture.
Exactly. That's a great way to put it. Type 1 events give you more evidence, more insight about conditions that were already there on December 31st. It's like you took a picture on December 31st, but later you get some info that helps you, develop that picture better, revealing details that were there all along but maybe weren't clear at the time.
Okay. And the source material gives some good examples, like getting better information about an estimate made back on Dick 31st. Maybe how much of a big receivable you'll actually collect.
Right, or settling a lawsuit.
Yeah, settling a lawsuit that was already going on as of Dick 31st, or a major customer going bankrupt, but they owed you money that was on the books on Dick 31st.
And warranty obligations, too. Settling a big warranty claim that related to products sold before year-end.
The key thing, like you said, is that the underlying condition, the lawsuit, the shaky customer account, the warranty issue, it existed back on December 31st.
Precisely. And because these events confirm or clarify something that was already present, type 1 events mean you must adjust the financial statements for that period. You actually have to make journal entries debit this, credit that to revise the numbers reported for the year ending Dick 31st.
So you're fixing the history.
You're fixing the history, exactly. Making it a fairer, more accurate picture based on this new clarifying information.
Okay, that makes sense. Adjusting for things that were already brewing. But what about stuff that genuinely happens after year end? Something completely new.
That's where type 2 events come into play. These are the ones that arose, that started after the balance sheet date. Think about maybe a fire destroying a warehouse on January 5th. That fire didn't exist on December 31st. It's a totally new event.
So for these type 2 events, you don't adjust the financial statements for the December 31st period. No changing the numbers for the prior year. Is that the main difference?
That's the critical difference, yes. No journal entries are made for that prior period because the condition simply wasn't there then. But, and this is important, that doesn't mean you ignore them. The required action for significant type 2 events is disclosure.
Disclosure. So tell people about it, but don't change the old numbers.
Exactly. If the event is important and relevant to users of the financial statements, people making decisions, you have to disclose it so the statements aren't misleading. This usually happens in the footnotes to the financial statements, sometimes for really major things, maybe even a press release. It's about providing context for the future.
Gotcha. So examples here might be like major changes in management or products that happen after Dacre 31st.
Yep.
Or unionization efforts starting up after year end. The Amazon example mentioned in the material. New marketing deal signed in January.
Right. Or losing an important new customer.
Ah, the new is key there. So the relationship itself started after Dacre 31st. It's not like clarifying an existing customer's situation.
Precisely. These events clearly originated after December 31st. No journal entries for the past period's books, but if they're significant, and significance is a judgment call, but usually means it could influence a decision, then disclosure is absolutely key. It helps people understand the company's current position and future prospects.
So it really comes down to timing, doesn't it? Did the root cause exist at the balance sheet date, or did it pop up after?
That's the fundamental question you have to ask for every subsequent event. Get that right, and you know whether to adjust or just disclose.
Okay, so wrapping this up, what's the big takeaway for you, the listener, whether you're, deep in CPA studies or just trying to read a company's annual report?
Well, I think the main thing is that financial reporting isn't just this static snapshot taken on December 31st. It's really a continuous process. It's about transparency and accuracy over time. The whole concept of subsequent events, needing to classify them as type 1 or type 2, it really highlights this. Even after the books are theoretically closed for the year, new information keeps coming. And that new information can change how we understand the past performance that's type 1 or how we view the company's future that's type 2. It shows that accounting is constantly trying to bridge historical cost with current realities and future expectations. It's not just about crunching numbers, it's about communication and telling the full story.
That's a great final thought. It's this ongoing dance between what happened historically and what's happening now or what might happen next. It adds a whole layer of dynamic interpretation, doesn't it?
Absolutely. Understanding subsequent events gives you a much richer, more nuanced view of a company's financial health and its prospects.
So next time you pick up a financial report, remember to look beyond just the balance sheet date. Think about what might have happened between then and the issue date. It could tell you a lot. Thanks for joining us for this deep dive.